Most people don't feel poor. They feel fine. Bills are paid. Salary comes on time. There's a car in the driveway, a decent phone in the pocket, maybe even a vacation once a year. And yet, after working for years, something feels off. Net worth doesn't grow. Savings feel fragile. One emergency can still cause stress. Today's video is not about blaming bad decisions. It's about understanding a system that quietly keeps people stuck. Not through failure, but through monthly payments. The comfort of monthly payments. Let's talk about how modern spending actually works. Most big purchases today don't ask, "Can you afford this?" They ask, "Can you afford the monthly payment?" A $40,000 car doesn't feel like $40,000. It feels like $650 a month. A $2,000 phone feels like $55 a month. Furniture, gadgets, even vacations, all broken down into small, manageable numbers. This framing changes how the brain works. When cost is divided into months, pain disappears. Decision-making becomes emotional, not mathematical. And that's where the trap begins. Why EMIs feel safe but aren't. 340. Monthly payments create an illusion of control. You feel responsible. You feel disciplined. You're paying on time. But here's the hidden problem. Your future income is already spent. Before your next paycheck arrives, a portion of it is already promised to the bank, the lender, the credit card company. That money never gets a chance to work for you. It doesn't compound, it doesn't invest, it doesn't create options, it simply disappears. Every month. Quietly. The wealth equation. Most people miss. Wealth is not built by income alone. Two people can earn the same salary and live very different financial lives. The real difference is who controls future cash flow. Every EMI reduces flexibility. Less room to invest, less room to take risks, less room to wait patiently. Over time, this creates a pattern. Income goes up, monthly payments go up, lifestyle expands, net worth stays flat. It feels like progress, but financially, it's just motion, not movement. The lifestyle inflation loop, 510 to 640. Here's something no one explains clearly. Most EMIs aren't emergencies. They're upgrades, a slightly better car, a slightly bigger apartment, a lifestyle that matches your peers. Each decision feels reasonable on its own, but combined, they lock you into a fixed cost life. When income rises, expenses rise faster. When income falls, stress spikes immediately. Wealth needs breathing room. EMIs remove that room, one payment at a time. Why the system encourages this? This isn't accidental. The economy prefers predictable consumers. People who make regular payments, upgrade often, stay dependent on credit. Monthly payments keep people spending without stopping to think. Because if people thought in total cost, many purchases wouldn't happen. So the system normalizes debt as responsible. But responsibility is not about paying on time. It's about owning your future choices. The real cost isn't interest. Most people think the problem with EMIs is interest. That's only part of the story. The bigger cost is opportunity. What could that money have become in 10, 15, 20 years? Invested early, small amounts grow quietly and powerfully. But EMIs reverse that process. They pull money from your future and spend it today. Not loudly, not dramatically, just consistently. Calm conclusion, 9-10-10. This video isn't telling you to never use credit. It's asking you to see EMIs clearly, not emotionally. Monthly payments don't make you irresponsible, but they do shape your financial destiny more than most people realize. Wealth grows when future income stays flexible, when decisions are slow, intentional, and boring. And once you see the EMI trap clearly, you don't feel guilty, you feel aware. If this helped you think more clearly about money, you can like the video and subscribe for more calm, honest finance conversations.